Welcome to our in-depth look at valuation risk, an essential component of investment decision-making. In this comprehensive video, we will explore what valuation risk is, why it matters, and how you can navigate this complex terrain to make better investment choices. To get started, let's understand the basics of valuation risk. Imagine you are considering investing in a company's stock. You review the company's financials, market position, and future growth prospects. Despite all your research, there's still a risk that the price you are paying doesn't accurately reflect the true value of the stock. This is where valuation risk comes into play. Valuation risk can arise from several factors, such as incorrect valuation models, market sentiment, or macroeconomic changes. For example, if a company announces excellent earnings but the stock price doesn't rise, it could indicate that the market has already priced in the good news or that broader economic factors are in play. Let's delve into an example. Consider Company A, projected to have a huge technological breakthrough. Analysts might overestimate its success, leading to a higher valuation. If the breakthrough doesn't materialize, the stock's price will likely drop, reflecting its true value. Now, let's address another aspect: market sentiment. Oftentimes, the stock market's reaction is based on overall market sentiment rather than company-specific fundamentals. For instance, widespread economic pessimism may depress stock prices across the board, even for fundamentally strong companies. This sentiment contributes to valuation risk by distorting the true values of assets. Now, to make this practical, let's discuss some strategies to mitigate valuation risk. One effective technique is diversification. By spreading investments across various asset classes, sectors, and geographies, you can reduce the impact of any single valuation error. Let's create a simple portfolio with stocks, bonds, and real estate. Another effective strategy is conducting thorough due diligence. This involves deep diving into a company's financials, closely examining industry trends, and keeping abreast of macroeconomic indicators. A combination of quantitative and qualitative analyses can provide a more accurate picture of an asset's true value. To quantify valuation risk, analysts often use financial ratios such as the price-to-earnings (PEE) ratio, price-to-book (PB) ratio, and discounted cash flow (DCF) models. These tools can help assess whether an asset is fairly valued. We're now going to take a moment to address some common questions about valuation risk. First up is a question we often get: how does one differentiate between short-term market noise and genuine valuation discrepancies? The key here is to focus on fundamentals and long-term trends rather than short-term price movements. Another question is, what role do interest rates play in valuation risk? Interest rates can significantly affect valuations, particularly for bonds and other fixed-income securities. As interest rates rise, the present value of future cash flows decreases, leading to lower asset valuations. It's also crucial to understand the role of macroeconomic indicators in valuation risk. Factors like GDP growth, unemployment rates, and inflation can influence asset prices. For instance, high inflation erodes purchasing power and can result in lower stock valuations. In summary, while valuation risk is an inherent part of investing, it can be managed through diversification, thorough research, and the use of financial ratios and models. Always be mindful of market sentiment, macroeconomic trends, and interest rate changes to navigate these waters effectively. Remember, the goal is to make informed decisions that reflect an asset's true value. Thank you for watching our comprehensive video on valuation risk. We hope this guide has provided you with valuable insights to help you make better investment decisions. Don't forget to like, subscribe, and hit the notification bell for more finance tutorials. See you in the next video.